what we've seen as far as gold and silver's price action over the past few months wasn't driven by the United States. But in Australia, people were lining up at coin shops, and this was happening all over the world. And so there comes a point where the paper game in the United States and in London can't continue overwhelming the physical market.
Over the last several months, the performance of gold and silver has quietly revealed a deep structural change in the global financial landscape. Despite weakness in the US dollar index and a persistent tightening narrative from the Federal Reserve, precious metals have maintained remarkable strength, with silver gaining momentum against a backdrop of escalating geopolitical tension and record-breaking central bank gold purchases. What's striking is that this rally has not been driven primarily by the United States. From Sydney to Singapore, from Dubai to Delhi, physical demand has surged as retail investors and institutions alike turn to tangible assets in anticipation of further currency debasement. This wave of global accumulation signals that confidence in the paper system, especially the dollar-denominated trade in metals, is beginning to fracture. The macroeconomic picture underpinning this move is impossible to ignore. Central banks continue to accumulate gold at a record pace, collectively adding more than 1,000 tons in 2024 alone, according to the World Gold Council. Meanwhile, the Federal Reserve, despite its public posture of resilience, has quietly overseen a near 20% expansion of the M2 money supply since 2020. Inflation, even as official metrics appear contained, has eroded real purchasing power in nearly every major economy. And while Treasury yields remain elevated, global investors increasingly recognize that sovereign debt markets, particularly in the US and Europe, can no longer provide genuine safety in real terms. In this environment, physical gold and silver are no longer simply hedges. They are essential reserves of value in a system stretched to its limits. Silver, in particular, continues to demonstrate asymmetric potential. Unlike gold, whose monetary demand dominates, silver straddles both industrial and monetary use cases. With the green energy transition accelerating, solar, EV, and electronics all requiring vast quantities of silver, the structural supply deficit has deepened. The Silver Institute reports that global silver demand outpaced supply by over 250 million ounces in 2024, one of the largest shortfalls on record. And while price volatility is inherent, it is precisely in these corrective phases that long-term investors find their edge. As Maloney notes, true wealth preservation often lies in acting against emotion, accumulating when others hesitate. The forces now aligning across the global economy, runaway government debt, persistent inflationary pressures, de-dollarization, and a tightening physical silver market, are converging toward a potential inflection point. When the artificial pressure of paper derivatives in New York and London can no longer suppress physical demand, the revaluation will be swift. And as history shows, once that pendulum swings, it rarely returns to equilibrium quietly. In today's video, Mike Maloney breaks down these dynamics with his trademark clarity. He examines not only the macro backdrop fueling this quiet bull market, but also the data-driven case for why both gold and silver could be entering their most powerful phase yet. He also dissects the emotional cycles that drive investors to chase price rather than value, and how mastering those emotions may be the key to long-term success in this sector. Stay tuned until the end for his discussion on the gold-silver ratio, market cap distortions, and why the metal's next leg higher may surprise even seasoned investors. If you find this video insightful, please like and subscribe, turn on post notifications, and share this video with other savvy investors. Thanks, and enjoy the video.
Silver is a roller coaster, and you need to have the stomach for it. It is a long-term investment, and to me, these are the times that I use to add to my position. Most people are chasing price, and it's best to try to be a contrarian. And it takes a lot of guts to do it. I think it's not an easy thing to go against your emotions, but part of successful investing is controlling your emotions and making sure that they don't control you. So, what have you got for us?
Yeah, well, I basically wanted to zoom out a little bit and sort of remind our viewers that the bull market is not even close to over. So I thought we could look a little bit at gold, a little bit at silver, and of course the ratio between the two. So
Yeah.
the first thing I have here is IMF data. Gold now exceeds 1/5 of world reserves. So central banks know what's coming. You can print dollars, but you can't print gold. They're stocking up on it. This is not the end. This is a continuation of a really long-term trend.
Yeah. Well, yeah, but you can see the acceleration of the trend really started in late 23. It is a long-term trend. In fact, that, you can print dollars, but you can't print gold. That was in my first book back in 2007, 2008. The point of this video, like you said, is it's not too late. It was better to be buying gold back in 2007, 2008, 2009. The longer that we keep on kicking the can down the road, the bigger the highs, the potential highs become, because it's all an inverse of what is the dollar going to do? It's like inverse, but it's also a magnifier.
Yes, exactly.
Yeah.
And I actually have a chart to show that in just a little bit.
Oh, okay.
So, so our next thing here, top assets by market cap. Gold officially becomes the first asset in history to hit $30 trillion in market cap. That's kind of crazy. But yeah, this is actually just what you just said, Mike, which is that there's so many dollars and you can print them. And what happens when you print 30 trillion of them is that the market cap of gold will be 30 trillion. So it's kind of wild.
Yeah, that was one of the key premises of the first book, is that gold always does an accounting eventually of the expansion of a fiat currency supply. And it's done this throughout history, and it's a reliable thing that you can just sort of count on. But it's all driven, it runs in waves and cycles, and it's driven by public emotion. And right now, the public isn't trusting the dollar enough, or actually, I need to rephrase that. They've trusted it too much in the past, more than it deserves. So,
yeah, I'm reminded of a quote from Warren Buffett. In the short term, markets are a voting machine. In the long term, markets are a weighing machine. And in the long term, the dollar weighs nothing. So you're going to need an awful lot of them in order to buy anything of substance. So that's what we're seeing here. One other bit of news here. India unleashes silver as banking collateral with a 10-to-1 gold-silver ratio, declaring silver global monetary metal. And I've heard a lot of people comment that this implies that the gold-silver ratio should be 10-to-1. And I think this is a huge misinterpretation about what's actually going on in India. So I actually just wanted to clarify that for our viewers. What's going on is that India is setting silver as collateral for bank loans. They're capping the amount of gold that you can pledge as collateral at 1 kilogram and the amount of silver that you could pledge as collateral at 10 kilograms. So that doesn't imply that the value between the two metals is 10-to-1 or that the price should be 10-to-1, nothing like that. It's like if they said you could pledge your house as collateral or up to 3 cars as collateral. That doesn't imply that the exchange rate between houses and cars should be 3-to-1. Not at all. So it's just interesting that the bank is allowing gold and silver to be collateral in the first place. I wouldn't get too hung up on the ratio of 10-to-1.
Yeah, except I do think that that's probably the area that it's destined for, simply because of the shortage of silver as compared to gold. And, we haven't gone into a global recession yet. And when we do, 60% of the, 2/3 of the silver supply is a byproduct of mining metals that are very sensitive to recession risks. And so just when people start rushing toward gold and silver as a monetary metal to protect their wealth, that's when the supply dries up. At the same time that demand increases, supply goes away.
So, Mike, you asked me to include the inflation calculator from the BLS because we were talking about silver and its all-time high of 52.50 back in 1980. And it has the same buying power today, according to the government CPI, of about $218. And of course, we're still not there yet. So we're well below the inflation-adjusted high. And this just shows us how much more time there likely is in the bull market before we get to those previous highs.
Silver is still a bargain, and we're going to show that with the gold-silver ratio. But I also asked you to do the inverse of this to give people an idea of where silver is compared to if its previous high in 1980. So let's there we go. So
Exactly.
it's at $12 and is that 61 cents?